Hi traders, and welcome to the next video in this course on naked chart analysis. In the last video, we took a look at technical analysis, what it is and why does it work. In this video and the next one, we're going to look at the technical trading methods that we use ourselves. But keep in mind that one of the things I also mentioned in the last video is that when it comes to the technicals, there are various tools out there. And we're only going to talk about the ones that we use, the ones that work for us. But you should go and explore some of the other tools out there because you might find that some of them work better for your trading style and the assets that you trade. Because of the nature of technical analysis, certain patterns, certain indicators will firstly work better for some traders than others. And they'll also work better for certain assets or certain time frames compared to the alternatives that you have. So you do need to go and explore and figure out what's going to work best for you. Now, for example, we're going to talk about naked chart analysis. For me, that is what works best. I don't use a lot of indicators. Indicators for me just don't work very well. So I prefer naked chart analysis. You might find that there are indicators out there which do work fairly well for you, in which case, by all means, go ahead and use them. You've got to figure out what works for you because every trader is different. Now, let's get into this video and learn about what is naked chart analysis. So this is a very minimalistic approach to technical trading. We only use price action and volume. And the reason for this, as I said, I don't really find that indicators work very well for me. And if you have looked at technical analysis in the past, whether it's with another educator or just the various online resources that you've got, you might have found that a lot of the images and charts they show you, there's a lot of indicators on them and there's a lot going on. A lot of traders, they have 3, 4, 5 indicators on a single chart. And for me, that just looks too messy and it looks too cluttered. And one of the other issues that I found is that when you have multiple indicators, you have a higher risk of getting mixed signals, especially if the technicals are the primary way that you trade. For us, it's the fundamentals. The fundamentals dictate what direction we're trading in, and then we use technicals. But other traders prefer to use technicals as their primary tool. And if that's the case, even if technicals are not your primary tool, if you've got too many indicators, you might get mixed signals and they can really mess with the conviction you have in a certain trade, because you could have one indicator saying that you should go long, another one saying that you should go short, another one might say that you should stay out the market. So which one do you then follow? So by having a less cluttered chart, I find that you're less likely to get those types of mixed signals. With that being said, you don't want to limit yourself to just one pattern or one indicator, because what we look for when it comes to the technicals is what we call a confluence. We're looking for areas where you've got multiple things going on. So for example, you might have a support level that overlaps with a trend line, which overlaps with a moving average. And if you've got a few things like that going on at a certain level, it means that that level is likely to be stronger, because remember, the technicals work better when there are more eyes on a particular level. So the more people you have watching it, the more orders you're likely to have around those levels, and therefore the more reactive the price is likely to be when it gets there. So you do want to have a combination of patterns or indicators that you use, but we don't want to overdo it and then end up having an information overload. So if some of these terms are new to you, then don't worry, we're going to look at them in just a moment. The final couple of points here, which we've already covered, is we're only using technical analysis to support the execution of our trades, which is why this minimalistic approach works so well. I would say that even if you are primarily a technical trader, try naked chart analysis out. You might find that having less going on the chart works well for you. And in terms of the naked chart analysis tools that we like to use, again, there's so many patterns out there, so do go and have a look at the other ones in your own time. But the ones that we like to use are very basic. They are just support and resistance levels, trend lines, and very, very simple candlestick patterns. So let's now move on to the next slide, where we're going to take a look at some examples of these tools. Before we do any of that though, we need to understand how to read a chart. So you might have seen this type of chart elsewhere on the internet, but what does it mean? So there are various charting platforms that you get out there, so not all of the charts will look exactly the same, but it will be very similar. Now, what we're looking at here is a chart of the US dollar against the Japanese yen on a 5-minute time frame. I'll explain that in a moment. So you've got all of these bars going across the chart. Some are blue, some are red. On other charts, you might have a combination of other colors. But here, the red bars indicate where the price has moved down in that period of time, and the blue bars are where the price has moved up in that period of time. Now, because we're looking at a 5-minute time frame, each bar represents 5 minutes of price action. So what happened, for example, like you can see here, this is 2:45 a.m. on this chart at this point here. So this candle right here shows you what happened between 2:45 and 3 a.m. or 2:45 and 2:50 a.m. The next one's then 2:50 to 2:55 and so on. You also get other time frames that you can look at. You can get 1 minute, you can get 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, daily, weekly, and monthly. Those are usually the standard time frames you'll get on any charting platform. Now, other ones may provide you with some more custom time frames. But again, when it comes to the technicals, it's all about looking at levels which other traders are looking at. So you don't want to mess around with it too much. If these are the popular time frames and the ones that are looked at most frequently, why do you want to go and try and do something different? I've seen traders that will try and look at a 2-hour or an 8-hour chart. But what's the point if nobody else is looking at that? The technicals don't work as well. You want more eyes on the chart and on a particular level. So that's the time frame. And then if we go into more detail about these individual bars, so what I'm going to use is the markup tool here, so we can just make it clear what we're talking about. So let's take, let's find a good one here. So let's take this bar here, this red bar. This shows you that the price moved down within that 5-minute time frame. Now here, what you've got is you've got this big red bar, which we call the candlestick, and then you've got these two lines sticking out, and these are what we call the wicks. So what does this show you? Now, since the bar is moving down, what the top and the bottom of the bars show you is the open and the close price. So if this was at, let's say, 4 a.m., then it shows you where was the price exactly at 4 a.m., where did it open, and then where did it close at 4:05. Now, in our case, since we're looking at a what we call a bearish candle, because the price moved down, if the price moved up, then it's a bullish candle. But because we're looking at a bearish one, that tells us that obviously this is where we opened, this top part here, right there, and the bottom is where we closed. So in that 5-minute time frame, the price moved from here to here. What the wicks show you is where the price has also been within that time frame. So these are the highs and the lows within that 5-minute period. So the top of the wick here shows us that the price went all the way up to here, but obviously it didn't remain there. It ended up coming back down, and then we finished closing lower. The bottom shows you that the price went as low as this level, but it ended up closing a little bit higher. Now, these wicks can be quite important when we look at some of the patterns in a moment, because they tell us a little bit about the sentiment in the market, so we can try and gauge what the sentiment is from those wicks. But that is how you read a candlestick. So the bar itself shows you the open and the close. The wicks show you the highs and the lows. So that is how you read a chart. And then across the bottom here, you've got the date and the time, and across the y-axis here, you've got the price. So that is reading a chart. Now let's move on to the next slide, where we're going to take a look at support and resistance. So this is one of the most basic tools. Now the chart we're looking at here is the US 500, which is the S&P 500. It's basically an index of the top 500 US stocks. And again, we're looking at a 5-minute time frame. Now, what a support or resistance level is, that's where you've seen the price testing that level on multiple occasions, and the price has reacted to that level on multiple occasions. So support is like the floor. It's where the price has come down and then bounced up, and then the resistance is like the ceiling. So the price has gone up and then bounced down. So if we look at the support, we can see here the price came down. It tested this support a few times. We can see we tested it here. We tested it again here. Then started to bounce a little bit, but then we again tested it here before we got this bigger bounce, and then we moved a little bit higher. We also tested the price a little bit around here. When we came back up, we tested a little bit and sort of hovered around there before going further to the upside. We tested it here and also here, and then here we just broke through it. Now, when you break through a support, that support turns into a resistance level, which we can see here. We had a break, we then bounced back, hit that support, that's now a resistance, and then saw a bit of a bounce again, but ultimately we ended up then pushing higher. And if we look around here, we can see that when we broke through it and before we came back up, we did chop around below it and then above it before we moved higher. So if you break through a support, it then turns into a resistance level. And a resistance level is what you've got at the top here. As we said, it's like a ceiling. So we can see, again, we have tested it on a few occasions. So the first test that we had was right here. So we tested the price, we tried to break through, it didn't work, and we came back down. Then we had another test there, similar sort of thing. We had a test there, again, similar sort of situation. And we had a test here and came back down. So this is one of the most simple tools that you have, just areas of support and resistance. Now, something to also keep in mind is we're looking at a 5-minute time frame here, but quite often the time frames that work much better, or the time frames where technical analysis works much better, will be the longer time frames. So something like 1 hour, 4 hours, daily, weekly. And the reason why is because even though a lot of retail traders will be day trading and they'll be looking at shorter time frames, the institutions, they don't really trade on these short time frames. They trade with a longer term outlook. They'll be getting into a trade for maybe a month, 3 months, 6 months, maybe even a year or longer. And even if you have, let's say, even if you have 100,000 traders, and in total those traders have accounts of $10,000 each. So between them, you've got $1 million that's trading on the market. And let's say all of this is on one asset. All of these traders are trading the S&P 500, which we're looking at here. Now, there's maybe 10 institutions, 10 big banks, and they're also trading the S&P. But those banks, between them, they have $1 million each. So in total, they're trading $10 million. So it doesn't matter that you've got 100,000 retail traders here. The amount that these 10 banks are trading is much, much bigger than what these 100,000 traders have. So what the banks do is going to have a much greater impact on the markets, because remember the supply of law and demand. If you've got 100,000 traders trying to buy, and they're buying the S&P 500, that's $1 million of demand to buy. But then if you've got $10 million of demand to sell, well, that's the direction the market's going to move in, because the demand to sell is much, much greater than the demand to buy. So this is why the longer time frames tend to work a lot better, because this is what the institutions will be looking at. So that covers support and resistance levels. And these are very important. They do work quite well, but also they don't just work as support and resistance. Something else that you can look out for, and this is a little bit more advanced, but the more often a level gets tested, what that also shows you is that not only do you have an area of resistance or support there, but if the markets start testing that level quite a lot, it shows you that the markets are trying to break out to the upside. So if you get multiple tests of the same level, and especially if they come in a short space of time, you want to keep in mind that the markets are trying to break out. And if they're able to break out, then there could be fairly strong momentum to the upside, or vice versa if you break through a support. For example, as you can see here, when we broke through this support, we very quickly dropped a fair bit. And when we broke back above it, it didn't take long to then go and hit this resistance up here again. So that is support and resistance. The next tool we then have is trend lines. So support and resistance levels, these are static. Once you draw the support on, if you had a support, let's say here, then that aligns with a price of maybe about roughly 11,300. And that's going to remain as it is. Whereas what a trend line offers you is a more dynamic resistance or support level. So we can see here that the price is moving upwards, and we've drawn this trend line, and very similar to the support level and resistance levels that we looked at, we've tested it on a couple of occasions and the trend line has held up. Now, because this is a dynamic support and resistance level, it's quite often significant when we break through it. And if we were to break through this to the downside, that would maybe indicate that the upside is finished for this cycle, and we're now going to see a trend to the downside. And if the support level, if the trend line holds up as support, then we're going to continue seeing upside. So quite often when you've got a, let's say you've done your fundamental analysis and you've now got a trade idea and you want to maybe buy the euro dollar and the price is already moving up. Now, what did I say at the beginning? We use the technicals to determine where to enter. So let's say the price has moved to this sort of level up here. So let's just mark this on. So let's say that you've got the price somewhere around here. So you've moved a fair bit already to the upside. And you're deciding when do you enter. Now, you know that at this point, you know you've got this trend line which has hit these 2 points. So it could potentially turn out to be a fairly strong a trend line. Normally, the more touches that you have on a trend line and the more it holds up, the stronger that trend line is. In this instance, it's only touched it twice, so it's potentially going to turn out to be a trend line, but we don't know for sure. But this is all we have right now that we can use. So you might say, okay, the price is here. So what I'm going to do is I'm going to wait for this trend line to be hit again. And if it holds up as support, then that is where I will enter my long position. So you almost came down to the trend line here, but you didn't hit it. So you ignore it. At this point, you did hit it. And you can see that you've bounced off it. So you can say, okay, the trend line has held up. That's where I'm going to buy. And then you can see we did shoot to the upside. Now, that's a very simple way to use it. But like I said, what we're looking for quite often is a confluence. We don't just want the trend line here. We want other areas of maybe support and resistance. So maybe what we can see here is there was a bit of a turning point here. So maybe there's some support here. So if I just roughly draw that on, it aligns with this area here. So you've got now a trend line and a support. So that makes that area a little bit stronger. If we extend this line to this side, we'll see that it actually aligns with this area here. So this was actually some resistance. It also aligns up here, roughly around this sort of zone. Apologies for the terrible drawing, but you get the idea. There's been multiple touches around that level, so you've now got a fairly strong support and you've got the trend line, and that's why you can see we've had a very strong bounce off of that level. So that is how a trend line works. Now, a trend line can also go in the opposite direction. We've got this one just going up. If we look here, we've got sort of a small trend line coming down a little bit. Again, it's a very rough drawing, but you can get trend lines that go down as well. So that is a trend line, and a small example there of how you can use a trend line in confluence with a support. Now, this is another example of a trend line, and something we often get when a trend line will break, or if a support breaks or a resistance breaks, is we get what we call a break and a retest. So the price will break through the level, but then it will pull back. It will retest that level, like we can see here. And then if it cannot break back above it, it then continues back to the downside. Now, what I'm also showing you here is that the markets are not going to play out in such a clean manner. We didn't just get a bounce and then collapse to the downside. We actually ended up drifting a little higher first before we then saw further downside. What you get a lot of people showing you on the internet is a very, very clean setup. But what we're looking at here is a combination of clean setups, but also realistic setups. The markets don't play that cleanly every time. And this is why we prefer the fundamentals, because it gives us more conviction in the trade, because you have more of a logical reason for being either long or short on a certain asset. Now, in this instance, you had a break and a retest. But when we got to the levels near the top, so when we pulled back up to here, you might have started to think, should I still be in this trade? From a pure technical perspective, we haven't gone and tested the trend line again, so you should keep holding it. Now, at this point, if you entered here, where would you have placed your stop loss? Probably a little higher than this resistance here or this resistance here. So it would be a little bit higher than that. But when you're looking at this price just drifting higher, in your mind, you're thinking that this isn't playing out, so should I close it? And then it ended up going lower, but the problem is that you might have closed it before it actually went lower because you got scared by that pullback. And again, this is why for us, the fundamentals are much more important, because it's easier to then gauge whether this is a pullback or whether something has fundamentally changed, and that's why the market is moving in this sort of direction. And to top it off, we were seeing a bit of an uptrend before, so you're then thinking that, is it maybe just that the trend line has become invalidated and the overall trend is still to the upside? So this is a realistic example of what could happen with a trend line. Sometimes the technicals don't work. And the same applies to the fundamentals actually. Sometimes fundamentally you can get everything correct, but the markets just decide to do something else. The markets can be very illogical. So no matter how much analysis you do, no matter how much conviction you have in a trade, always keep in mind that the trade can go against you and you can still lose that trade. You might think it's an absolute certain trade, but you can still lose it. And losses are just a part of the game, whether you're trading on the technicals or the fundamentals. You will suffer losses, and this is just an example of how the trade might not work out. So that was another trend line example. Now, some of the patterns that we look at. So we've looked at support. And when you have an area of support, one of the patterns that can form when you've hit the bottom is what we call a double bottom, because we've hit that level twice on two separate occasions. When you've got a lot of bouncing going on at the same level, that doesn't count as a double bottom. It's got to be a fairly clear, you've had one bounce, you've pushed higher, and then you've had a second test, and then you've pushed higher. That shows you that the support is holding up. But also, if you have a lot of tests and you're not getting a convincing bounce, like we've sort of had here, we've actually gone higher. But if we say only bounced to here and we didn't break above these highs that were formed after the first bounce, then and then we went down and tested it again, that maybe indicates that the market appetite is to go lower and break through the level. In this instance, we've actually broken, we've continued to break higher. So this is an example of a fairly clean way that this plays out, but it doesn't always happen that way. Sometimes it can be very, very messy. So that's a double bottom. If you get a third bounce, if you get a bounce again and then you come and test it, that's what we call a triple bottom. So that's also another pattern, and it works very similar with resistance levels. You can get a double top or a triple top. But as I said, the other side of it is if the markets are just repeatedly testing that level, it maybe indicates that they want to break through it. So that's a double bottom pattern using a support level. Now looking at some of the one of the candlestick patterns that we like to use. So this is the engulfing pattern. So what we can see here is we've got an area of resistance. So we broke through, we almost retested at this point here, but didn't quite get to that level. We came a bit lower, we tested it here, came back down, tested it here, came back down, tested it here. Now, see, this is where if you had all of this going on, sorry about that, that's actually gone completely wrong. So let's draw that on again. Okay, so if you had this support around here, which we've tested a few times. Now, as I said, if you had this going on, you'd be thinking that the markets are not breaking. They've broken this level, but they're not breaking lower. Do they want to edge higher? Are they trying to break back to the upside? Ultimately, we ended up breaking to the downside. So again, remember, every pattern is not going to play out as cleanly as you hope. And some patterns do work a lot better on certain assets compared to others. So when you explore technicals yourself, you'll find that there are certain rules. Like, for example, some traders will say only trade in the direction of the overall trend. So if the overall trend is to the upside, you should only look to buy. So you should either be looking for a bounce from a support or a break of a resistance level. If the trend is to the downside, then you should only be looking to sell. There's also volume that you can use, which I'll talk about in just a moment. But in this instance, we've tested this level a few times, and then what we've had here is what we call the engulfing pattern. So we've had this test, and then we've had this big bearish candle. And this bearish candle has engulfed the previous candle before it. Sometimes it can engulf multiple candles that came before it. In this instance, we've only engulfed the one. We've engulfed almost over 50% of the of this one here as well, but we fully engulfed this one, and that's usually that's considered to be a bearish signal. And because we're looking for a confluence, what we've also got is that this pattern appeared around a resistance level, and we then had another bearish candle, which could be considered a confirmation. So that's when you could maybe look to go short, and then we can see that we have continued lower. Now, another approach you could take is you could say that we also tested this level a couple of times and we haven't broken it. So you could then say, okay, we've got a bearish engulfing pattern here because it's to the downside. And then here we've broken through this level. So after breaking through that level, that could be maybe when you say, okay, now I'm going to enter because we've found resistance here and we've broken through here. So you miss out on a bit of price action here. But for you, you might say that, okay, this is now a stronger signal. Again, every trader is different, so find what works for you. Some traders might have entered right up there. Some traders might have waited for this break here. And then in this instance, we did end up trading to the downside. So that is an engulfing pattern, and you can also get a bullish engulfing pattern that would be in the other direction. So for example, this one or this candle could be an example of a bullish engulfing because you've engulfed the candle before that. It's a little trickier on currency pairs. What you can get on individual equities is, because equities don't trade 24 hours a day like currencies, what you can sometimes get with equities is, let's say you had this candle here. Now with equities, because equities don't trade 24 hours, there is what we call pre-market trading, where some of the institutions are able to trade before the markets actually open. So that means that the price could actually open up here rather than where it closed in the previous session. And then you could close here. And that is a full engulfing candle because you've opened higher and you've completely, this candle here is completely within the range of the candle that comes after it. With currencies, it's not going to be like that because currencies do trade 24 hours a day. So typically the following candle is going to open where the previous one closed. But yeah, these are examples of, these could also be examples of bullish engulfing patterns. And in both instances, we did get a bit of upside. It didn't hold up for too long, but we did get some upside. So that's an engulfing pattern. And then another one which we like to use quite often is the hammer and the inverse hammer. So this is where you hit a level of resistance or support, and then you get this sort of price action, which we can see here. So the price tries to either move to the upside or the downside, depending on where we are. Now, if we've got resistance, which we kind of have here because it was very quiet and we were just trading within this range up here. So you get this test of the resistance, and then the price comes back down quite quickly and ends up closing in this pattern. So you've got a small candle, but a long wick. and that's normally considered to be a reversal pattern. And then we can see here that we tested that same level again before eventually coming down. So again, you'll keep hearing me say this, but this is an example of where the pattern hasn't played out that cleanly. It could have just bounced and then just drifted lower. None of this upside here. But in reality, it doesn't play out like that. So this is why we look for a confluence. It adds a bit more conviction and a bit more strength to the levels that we are looking at. Now, another tool that a lot of traders will use when it comes to naked chart analysis is volume. There's a reason why I haven't got volume up here. So firstly, what is volume? This is the volume shows you that in a certain space of time. So if we're looking at a 1 hour candle here, we've got H1, so that's 1 hour. So each candlestick will have a corresponding volume bar. And the volume bar shows you how much volume of that asset was traded in that 1 hour. So for example, if the volume is, let's say, on the US 500, if it's, or let's say we take a stock, it's a lot simpler to explain with a stock. If you have the stock Apple and you have a volume of, let's say, 50K, that tells us that 50,000 shares of Apple were traded in the hour. Now, it doesn't tell us whether they were bought or sold, but if you've got a candlestick going up, that tells you that overall, the spread was in favor of the long side. So more shares were bought than were sold within that 50,000. And the way that volume comes into play with the technicals is you can look at, when you have the volume, you'll have basically an indicator across the chart showing you different volume bars for each hour or each 5-minute candle, whatever the time frame is. And you'll be able to see what the sort of average volume is. Now, when you get to these sorts of candlestick patterns, or you get to a support or resistance level, the volume can be a very good indicator in telling you how much momentum there is behind a move to the upside or the downside. So for example, if we had this hammer pattern here, and then the corresponding candle was a bearish one, and the volume for it was very high, that tells us that there's a lot of momentum to go short. And that would tell us that there's an appetite to sell the S&P 500 or to sell Apple, wherever the asset is that you're looking at. In which case, then it looks like a trade that you might want to get involved in. On the other hand, if we saw this type of candle but the volume was low, then it tells you that there's not a lot of momentum behind that trade. So a short position might not hold up, in which case you might want to just ignore that pattern or that signal. Now, the reason why I don't have volume up here, the main one is we've looked at a few FX pairs. And even though brokers or charting platforms will offer you volume on FX, you've got to be very careful about using it because a lot of the time it's not accurate. When it comes to individual stocks like Apple, they're traded through a central exchange. If you want to buy or sell Apple shares, you'll do it through your broker. Or if you're a high net worth individual, or if you're an institution, you might go to the bank and say, you might go to an investment bank and say you want to buy or sell this many shares. Now, when they execute that for you, those orders all go to the New York Stock Exchange. In the same way, if you want to buy a stock in London, it will go to the London Stock Exchange. So there's a central exchange for where these orders take place. So when you're then getting the volume data, you basically get it from the exchange. The exchange can tell you exactly how many shares of this company were traded in this given time frame. With FX, it doesn't work like that. Because when it comes to FX, FX is what we call an over-the-counter market. You don't have a central exchange for FX. So when you place a trade order for a currency pair, let's say the euro dollar, what will happen is, let's say this trade you're placing is of a $10 million size. Now, there'll be multiple liquidity providers who are usually the big banks. So they'll be sent the orders. They'll be told that someone wants to buy $10 million of euro dollar. Who can complete that order for them? So bank one, let's say Citibank, they might say, okay, we can do 2 million of that order. JP Morgan might say, okay, we can do 3 million. Bank of America might say, we can do 2 million as well. So there's 7 million done there. And then Barclays might come and say, we can do the remaining 3 million. So your trade then gets split up and gets filled by these 4 different banks. And those orders don't go to a central exchange. It really just depends on how much liquidity each of these banks have in the currency that you're trying to trade. Do they have someone to take the other side of that trade for you? Which is why we call it an over-the-counter market. You've got to basically go to them. Now, this is all done in milliseconds and done through algorithms, but you basically need to go to the banks and say, I want to buy X amount. Are you able to give it to me? So that they have to then say that, yes, we can either supply all of it or we can't. We can only supply this amount. Think about when you go shopping, if there's a shortage of some sort of food, let's say it's bread, you might be able to buy some bread from one supermarket, but then you might need to go to another to buy a few more packets and then go to a third one to buy a few more. So it's a similar sort of thing when it comes to FX. And because of that, there's not any real volume data because they're not required to publish volume data. So it's not accurate. Now, what you also get, well, what we're talking about here is spot FX. What you also get is FX futures. So futures are a derivative. We'll talk a little bit more about derivatives in the next section. But when it comes to derivatives, they are traded through a central exchange. So for those, you can get volume data. So for FX futures, volume data is available and it's accurate. But generally for FX, because it's a spot market and it's an over-the-counter market, the volume data that your broker might provide you or another platform might provide you is probably not going to be very accurate. A similar thing applies to indices like we're looking at here, like the US 500. Because ultimately what indices are, these are just a gauge of how the overall stock market is doing. Now, what a lot of companies have done is they've created ETFs which track these indices, and the way they track them is they basically have the same stocks which are used to price the index with the same weightings. So that way, when the index moves X%, the ETF moves X%. So you can get exposure or you can trade the index by purchasing the ETF. Now, in the type of trading that we do, we're trading what we call CFDs. So we're not actually buying the index, we're just trading on the price. So we're just sort of betting on which direction the price will move in. If it moves in that direction, we make a profit. If it doesn't, we take a loss. So volume data for indices is also very difficult to come by. But for certain indices like the S&P 500, the most popular ETF to trade the S&P 500 is the index with the ticker SPY, the SPY index. It's the one that's the most traded for the S&P 500. So if we wanted volume data on the S&P 500, what traders will often do is they'll go and look at the volume data on the SPY, because again, that's an ETF. It's traded very similar to stocks. It goes through a central exchange, which means that there is volume data available for it. So volume is another tool which can be very useful. I would encourage you to go and look at this in more detail online, like I also said about going and looking at some of the other patterns online. But volume is not something that we use much because it doesn't work for FX or indices. But if you're trading individual stocks, then it does work, and it's definitely something I would recommend using. But these are the main patterns and the candlestick patterns and technical patterns that we use when it comes to naked chart analysis. As you can see, there's no indicators. It's all about drawing on lines of support and resistance or trend lines, and then looking for these candlestick patterns that we've talked about. These are just, we've only gone through 2. There's so many other patterns out there which you should go and have a look at. And the final point I'll make is, when it comes to naked chart analysis, when it comes to opening up your chart and looking at if there's a level of support or resistance, or if there's a trend line, the rule that I like to implement is, if I can't see anything within about 10 seconds of opening that chart and looking at that particular time frame, there's nothing there. Because if I can't see it in 10 seconds, what I'm going to do is try and sort of force a level and say, okay, this could be a support or this could be a resistance. But if it doesn't stand out to you in 10 seconds, the chances are that there are fewer eyes on it. And remember, we want as many eyes as possible on those levels. Now, if you're starting out, it may take you a little bit longer to identify these levels of support and resistance. But once you gain some experience, then stick to the rule that if you can't see it within 10 seconds, there's nothing there. You can then move to either a higher time frame. I wouldn't really recommend moving lower to just try and find a support or resistance. You probably want to start off with a lower time frame and move higher. And again, when you move higher, 10 seconds again. If you can't see it, it's not there. Look at the next one. But also, don't just keep looking at time frames that you don't normally look at to try and find a pattern or sort of force a pattern, and then essentially force a trade out of that asset that you shouldn't really be taking. So this is a fairly lengthy video that covers the main patterns that we use. In the next video, I'll go through a couple of the indicators that we use as well. I hope you guys have found this useful. If you have any questions, then as usual, send them in to us and I'll be happy to answer those. If you've got any questions about the patterns we've talked about, if there's any patterns that you have found online that you think work well and you just want our sort of advice or guidance on what we think about it, that's perfectly fine as well. Send it in to us, and we'll be happy to give you our thoughts or give you further guidance. So thank you for watching and see you in the next video. Cheers.